There is a window of opportunity, I would say, for Washington at the moment to cut rates aggressively, or to ensure that the Fed cut rates aggressively, and they're pushing, obviously, for this agenda.
Hello, and welcome to our Market Outlook podcast called Making America Stronger Again. Imric and I will be looking at the major themes that are currently driving the markets. Hi there, Imric. Thank you for joining.
Hi, Lorna. Hi, everyone. Pleasure.
The summer, it seems, is well and truly over, but the US trade war is still very much a live issue. Are we now in a position where we can declare a winner in the trade war?
If there is only one winner, it's going to be the United States of America. So the US average tariff rate being applied to its trading partners is now around 18%. Just as a reminder, it's just shy from the maximum that was theoretically reached in April. That was around 24%. And just to put it in context, that's the highest since the early 1930s. Despite that, Donald Trump has achieved what he wanted.
Well, that is a very clear way of looking at it. And is there then another way of looking at any impacts on the US economy from these trade tariffs?
So obviously, making America stronger again is a reality. And so far, the risks of either deflation or recession haven't really materialized. US real growth is still resilient. For the year, it should still grow around 1.5%, so it's low, but it's still positive and resilient. And inflation is pretty stable, so it's between 2.5% and 3%. Today, we just had the latest CPI at 2.9%, but it's accelerating a bit in the second half of this year due to the tariffs. But overall, the picture remains good, although the pace of job creation has slowed down. However, we probably haven't seen the full impact of the tariffs yet. So some trades could be diverted elsewhere. For example, some trades that originally were supposed to go to the US. The tariff pass-through rate to consumers is unknown. It seems that 50% of US companies don't really have a strategy on what to do. So either to increase prices or absorb that with their own cost. And that will vary between industries and companies, depending on the pricing power of those companies. And therefore, companies' margin could be impacted, but those margins continue to improve because productivity remains strong and companies find new ways to grow or reduce costs.
Yes, we can see that margins are improving so far, but the outlook might well be uncertain. And that puts the Fed in a difficult position. And they're being put under pressure by the Trump administration, who not only want to slash interest rates, but also to generally to increase their influence on the Fed's decision-making.
Yes, not very easy to be at the Fed at the moment, either in the seat of a governor or in the seat of the chairman. But that's part of Washington's strategy. There is a window of opportunity, I would say, for Washington at the moment to cut rates aggressively, or to ensure that the Fed cut rates aggressively, and they're pushing, obviously, for this agenda. The job market has been slowing down. So the latest data in August show that only 22,000 jobs were created. And inflation, as I mentioned, is still below 3% for this year, and went as low as 2.4% actually this year. So it's normal that concerns about Fed independence are there. It's legitimate, but the market seems to see this as almost overdone, and it hasn't stopped the market to price 1.5% of rate cuts between now and the end of 2026. So that's a lot. Now, why is it part of Washington's strategy? Is simple. It's because if the Fed rates drop and drop by a lot, the US Treasury can issue US T-bills at a lower yield. that can also push the US Treasury to reduce the supply of long-term bonds. As a result, the yield of long-term bonds can drop, and that will help housing and property markets. So all in all, cheap cost of financing the debt would allow also the administration to cut taxes, and that is crucial for Trump.
Yes, because we have seen some quite marked moves within the US Treasury bond market. So we've seen rates rising at the long end and falling at the shorter end in anticipation of rate cuts.
Yeah, so I was saying 150 basis point of rate cuts expected over the next, let's say, 18 months, rough and dirty. But in the meantime, the US 10-year Treasury yield has still managed to drop 50 basis points compared to the start of the year. And why? Simply because it has benefited from those expectations, but also from the receipts from the tariff and from contained inflation. So within fixed income, on our side, we tend to prefer to invest in investment grade and high yield bonds simply because they offer higher carry, especially in places where cash rates are low, like in Europe. So as a reminder, in the euro area, cash rates are around 2%. But also we like credit because in this environment, there's a low risk of corporate default. So we just harnessing, if you want, this excess yield compared to cash.
Yes, and just as a reminder to our listeners, that by carry we mean the interest that an investor will receive by holding those bonds. But as an aside, does this fear about the Fed independence explain partly why the price of gold has been so strong?
Yeah, the dollar has been the shock absorber so far as per Trump's agenda. I was saying earlier that was one of his objectives, getting a lower dollar to make America more competitive. Now, gold is acting as the currency of last resort. So when growth is low, when interest rates are being cut, the appetite to own various currencies is low, and gold again acts as a last resort. So it also benefits from retail flows and from global central bank diversifying their reserves, and that is mainly because of geopolitical risks.
Which is a fair response indeed. But equity markets seem to be taking it all in their stride. As you said, the S&P has been strong and it's touched record highs again recently. But how do you feel about valuations at these levels?
We can't hide, and valuations are stretched, obviously, for many equity markets compared to history. Now, valuations are kind of supported by this sort of friendly fiscal and monetary policies that are being applied either in China, in Europe, or in the US. But valuation are also supported because of positive earnings growth expectations going forward. So for the next 2 years. And we expect a broadening of the growth that the tech sector has enjoyed, a broadening across other sectors and other regions than the US for the next 12 months. So for example, if we take the Max 7, they expected to grow earnings by 21% this year versus 4% for the rest of the stocks listed on the S&P 500. But for next year, for 2026, the tech sector, the Max 7 could grow 16%, whilst the growth of the other companies' earnings could accelerate to 12%. So there's still a gap in favor of Max 7, but this gap is narrowing. And all in all, the spending we're seeing in artificial intelligence, in AI, is expected to translate into higher productivity and higher margins for most businesses. It takes a bit of time, but we expect, again, those businesses to benefit from that. So as long as growth is being delivered, investors will be ready to pay a high price to own equity going forward. However, we'll still have to watch those events very carefully.
Yes, we do. And markets really do need those earnings to come through. But apart from earnings, what could put the brakes on the positive run the equity markets have seen?
Yeah, so At that stage, it's all about earnings. It's all about the discount rate. Yeah, we were talking about the Fed and the 10-year in the US. High valuation multiples ultimately are, as I mentioned, they helped by fiscal, by monetary policies, by the expectations of AI-related productivity gains, and the market can remain expensive for a bit as a result. So now what could derail it are disappointments on the earnings side. And we've seen that every time a company released disappointing earnings, it was sanctioned and basically fell quite aggressively. It could also be higher inflation, because if there is higher inflation, that could lead to lower rate cut expectations. But so far, we are not seeing such signs. So we'll keep our eyes open, as I mentioned. High valuation also means less room for disappointment. But so far, the signs are not there.
Okay, and so how is this reflected in our allocation among equity markets?
Yeah, so we continue to own cyclical assets such as equity, so global equities through diversified regional and sector allocation. So we're not pointing to a particular sector. We believe in this broadening story going forward. And we own more of credit, so investment grade, high yield, and all that despite those demanding valuations. So within fixed income, our preference still goes for European high yield, for example. We avoid taking any currency risk now. We're neutral on the dollar versus the euro, for example, simply because the dollar could remain under the pressure in a Trump world and in a world where the Fed could continue to start first and then continue cutting interest rates.
Thank you, Aymeric. Until next month's Outlook.
Thank you, Lorna. Thank you, everyone.